Okay, guys, what's up? It is Tuesday, dang, 23rd of January. We are flying through January, and it is literally about to be the end of the month this time next week. So, our weekly video this week, I'm going to talk about mitigating common pitfalls in a hard money loan transaction and effective communication strategies. A lot of times, people don't pay attention to anything that is sent to them or read, emails, any documents that they're signing. They don't pay attention. And then they get to the end of the loan. Well, you never told me that, or you never talked to me about that, or you never did this, or you never did that. We hear it often, not as often as most people probably, but we do hear it often. Like, you never discussed this with me, which is absolutely not true because it is in your documentation most of the time. Look, I could sit and talk to a client about one transaction for at least 4 to 5 hours and still not be able to cover everything that you need to know. That's why we have what we call um, we have different emails that we send out that we make you read, or that we would hope that you read. And we also have disclosures that we send out as well. And that is one of the biggest things that you need to read verbatim, especially dealing with any hard money lender, is read the stuff that they're sending you and make sure that they're disclosing everything about that loan, because it's important. It's important for you to understand exactly what you're signing up for. It's important to understand because not only are you getting into a real estate transaction or an investment property, you're also responsible for making sure that you meet all the requirements that the lender has out there. And making sure that you understand how the loan is structured, how draws work, and how all of those things work. So, hey, if you're one of our friendly competitors and you're not doing this, you might want to start. It might help your business model. Loan terms misunderstanding. We have really mitigated this in the past. I mean, and been very effective in making sure that our clients are aware of what the loan terms are way up front. We want to make sure that that is clearly written out. You never want your client to be like, well, you changed rates on me, or these aren't the terms we discussed, blah 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 at the end. So what we do is we send out an initial loan estimate and implore that the client talk to us about it. What do you see that works? What do you see that doesn't work? And it has been very successful for us to have that open conversation up front. Well, Rob, that doesn't work for me, or Rob, I need a little bit of this or a little bit of that. Some things we're able to maybe negotiate. Some things are just that's how the loan is structured, and we can't move past that. But having that clear conversation up front and making sure that your clients understand, or the client understands what they're getting into as far as the loan terms, that's imperative. Um, Funding delays. It is true in any type of change in real estate, or change in the way things happen, or the way things people do business. It changes with the market. When things tighten up, kind of like the environment we're in now, it delays funding, not necessarily closing, but funding, because you got everybody that clinches when you're in a rough market and says, ooh, they're just uneasy. Everything, money's not flowing. You got inflation, you got unpredictability, you got rates high, you've got all these things that are out there in the investment fear, I call it, that literally will deter lenders and their funding sources from wanting to move as fast as possible. Now, we still close quick, But funding is a different thing. In some cases, we want to make sure that the dots are dotted, the T's are crossed, and all of that stuff is done to ensure that we didn't miss anything. And a lot of that has caused a lot of pushback from sellers because they don't understand. We make it clear to our borrowers up front, but then the sellers get aggravated and they call and we explain how we do things, and they're like, well, is this even going to fund? And we always fund it. It just takes us a little bit longer because our banks want to give a second look after all the documents have been signed. Our investors and where we get our funds from want to take a second look at the docs. And that's to be expected in any environment that we're currently in. So open and clear communication with your seller, your title agent, your with us as well, saying that doesn't work for me. I need to make sure that funds are dispersed, at this time, and there's certain adjustments we can make, but typically we want to make sure that those open lines of communication are there. The worst thing you can do is not pay attention. Again, going back to documentation or emails or even stuff that's written in emails, because we have a warning on all of our documentation that says when we will fund after all docs are signed, and people never pay attention to it, but that's hopefully going to change because we're doing this marketing video and everybody's going to listen to it and everybody's going to read it and everybody's going to know, hey, Jet Lending has this policy in place. But at the end of the day, look, we're always here to accommodate our clients and make sure that they're being taken care of the best way possible. I mean, you can't find a negative review on us. There's a lot. We've been doing this business for 20 years, so we always want to make sure that our clients are taken care of. Property evaluation disagreements. Oh man, if I could count the disagreements or the long conversations that we have had about values and how the ARV is higher, and we think it's lower. You got to understand, when a company like us has been in business for 20 years and we have a good feel on where we think values are, you've got to take the warnings that we give you. At the end of the day, are we always right? Maybe we're off a little bit, but I don't think we are. And any hard money lender tells you, hey, these are where the values are. We're not looking at the top of the market and saying, oh, it could sell at $400,000. But when you got two comps sold at $400,000, we look at the medium and say, where's it going to move the fastest? Because that's what you're targeting, is the fastest moving property, because that's what you're competing with out there. Yes, you may do the greatest rehab and you may do the most wonderful, beautiful home that doesn't even compare to the rest of them. Again, keeping in mind not overdoing it for that neighborhood or that environment. And it may sell quick, but as a lender, we can't take the risk that you're going to take. So we always look at where things are moving the quickest, and your competitors. Your competition is always going to be out there. So, and I mean competition by other properties selling, whether it be, just a regular homeowner selling or another investor selling in that area. So, that's why we do an upfront analysis on the property, and also we get a third party appraisal to ensure that our numbers are correct. You definitely got to have that in any circumstances when dealing with high dollar amounts and in dealing with investing in real estate. You've got to make sure that you get an appraisal to back up your numbers, because you can use that as evidence down the road, and it's always sufficient to do that. Uh, Here's one thing that most of our clients are always kind of doubling back on us, and that we've seen, and hopefully this solves this issue. I'm going to give you an example. Let's say you do your due diligence up front and the repairs are $40,000 on a property. But afterwards, you go back in and you tried to do the best job you could, but you figure out that the repairs are actually now $60,000. And you come to us and say, Rob, the repairs are 60. And we're like, oh, well, okay, but we've already closed the loan. We can't up the repair amount. We're already at a 70% loan to value minus the repairs. We can't go back and up the loan amount. Automatically, the borrower wants to step into, well, I'll just pull the 40,000 from Jet, and then on the back end, I'll use the extra my money to fix it. That's not the way this works. That's not the way our hard money works. We actually have to take that new $60,000 into consideration. Now, we'd have to break that up, let's say over four loans. That's an additional $20,000 divided by four. That means you got to put $5,000 of your own money plus what you were supposed to do. Let's say you take 40,000 and divide it by four. So you got to put 10 of our money and 5 of yours in it as you go, because now you've got a higher budget. So you take 10 and 5, that's a $15,000 draw. Another thing most people don't understand is that we do not pay on demolition. We are most at risk. Hard money lenders are most at risk when the property has been demoed. So the first thing you're going to do when you get an investment property is go in and immediately demo all the bad stuff out of it. And then you want to come in and take a draw. Well, you haven't completed anything. You haven't added value to the property. And we're lending off what's called an after repair value. So we're not leveraged at that time. So we always tell our clients, listen, you have got to do repairs and finish and get those repairs finished, and do it the right way and get them completed, not counting the demolition, and add value to the property so that we're able to release money as you go, because value has been added to that property. Big miscommunication there with a lot of, not all of our clients, but a lot of our clients, that hopefully that me explaining it in detail kind of gives you a perspective of where we stand as an institution when we present these photos to underwriting and they say, well, no, nothing's been done. Well, yeah, they demoed it. Well, yeah, they demoed it, but they've decreased the value of the property of where we sold, of what we lent at closing. So you've got to go in there and do, with your own money, account for each line item that you're demoing and add it into your repair budget. I'll give you, for instance, let's say you're going to do a new roof on the property and you're going to do new siding, and you got to rip all the siding and rip the roof off. All right. So there's going to be cost involved in that, right? So the cost involved in doing that, let's say it's $5,000 for siding and a roof to come off, but it's going to cost you $15,000 to put siding and put a new roof on the property, right? Well, your total cost is 20. So you have to add it into each line item what it's going to cost for each of those to do the demo and repairs, and you get reimbursed once those repairs are completed with that demo line item being in there. Understood? Okay. Moving right along. Insufficient due diligence. Oh man, that is a communication breakdown. You have got to do your due diligence up front on the property. Not only do we do it, but you've got to do it as well, because that's one of the biggest things that can be a hiccup in any real estate investment transaction, is doing your due diligence. Termite damage. Does it have termite damage? Are you going to have to do new plumbing? Does it need a new roof? We can help you with that. Look, if the roof looks faded, it's going to hurt you on curb appeal. I promise you that. It will hurt you. Do not skimp off of a roof. Most people, first thing they do when they drive up to a property, say, "Ooh, that needs a roof." Guaranteed. There's been so many clients over the last 7 years, I can count them, probably 20 of them, that have said, "Oh, I'm not putting a roof on it." Well, we're going to require you to put a new roof on it and get reimbursed. And they're, "Oh, it doesn't need a new roof." And I send them pictures of it, and you're telling me this doesn't need a roof, but it's worn, it's faded, the tabs are lifting up. You can obviously tell from a distance that this property has to have a new roof. And they're like, "Oh, well, blah, blah." I'm saying, look, I'm telling you, it's going to save you in the long run to put a roof on this property. And they usually listen, and it gets sold. I've had people call me, "Rob, this house ain't selling. It's not selling. I don't know what's up." I'll go in and look at the MLS photos. I said, "You didn't put a new roof on it?" "Oh, no, no, no. We're not putting a roof on it. It doesn't need it." Blah, 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 blah. And then I say, "Okay, I guarantee you, if you put a roof on this property," and I go and look at the repair, but and we even allocated money for that roof. We're still holding that money. Why don't you just put the roof on there? He's like, "Well, it doesn't need one." Again, they'll go and put a roof on it, sells immediately. So that is one of the big ticket items. Making sure you do your due diligence on any property that you're looking at. Exit strategy. Exit strategies are huge right now, huge. And cash reserves. Had an interesting a client call me yesterday about cash reserves. Wants to do $1 million property, got $70,000 in the bank. He's got a good nest egg of $70,000, but to do a rehab with total loan up to $1 million, you need significant cash reserves, just so that you can make sure that you're able to carry this, what we call carrying cost on this property. Heck, your payment alone is going to be high, $10, $11, $12,000 a month, depending on what the interest rate is and taxes. That's expensive on these $1 million houses. You'll run out of the $70,000 very quickly. Plus, you have to add value to the property with your own money, and then come to jet lending for the reimbursement, or come to us for the reimbursement. So knowing that, how much would you think that you would need to do $1 million property? I would say anywhere from $300,000 to $400,000 of cash liquidity to keep you comfortable. And he sat there for a minute. He said, "I never thought of it that way. That's interesting." He's like, "You're absolutely right. I would get in trouble very quickly, and wouldn't be able to meet the expectations of the loan, and this would probably die out." It would. You've got to make sure that you have those clear, open communications and the difficult conversations with your clients. Sometimes it's very hard to tell a client no in our industry or any sales industry, but sometimes they need to hear it. The most difficult thing is for me to pick up a phone call and say, "This deal doesn't work," because I don't get paid to sit here and evaluate deals. I do it for free for all of our clients. And we do that because we want to make sure in this investment industry that we're taking care of our clients and making sure that you're getting into a deal that makes total sense. That's why we do it for free. I look at well over 300 properties a month, and we close maybe 25 to 30 a month. 25 to 30 a month. Now, if I'm looking at 300 deals, don't you think I want to close all 300 deals? I would love to do that. I would absolutely love to be able to close all of them. But not every one of those is a deal. You got to pay attention to your purchase price. You've got to talk to a hard money lender, even if you're not going to use a hard money lender. Talk to them. Get their thoughts, their feelings on how and is this a viable deal. You may want to use your own cash, but use the hard money lending underwriting model to make sure that you're getting in a deal that makes sense. Sounds legit to me. The last thing I'm going to touch base on is email communication. One of the worst things I see in this industry over the last 7 years is the way that people email back and forth with each other. I'm always a pick up the phone and explain it type of guy. I don't want to email it. I don't want to sort of sit here and write this long email back and forth. I'm going to call you and explain it to you. It's one of my pitfalls because if I know that I should probably write it down, that way you can read it and understand it. But if I sit there and explain it to you and you listen to what I'm saying, I feel that it's better source of communication, and that may not always be the case. But I see a lot title companies, processors, all over the industry that will sit here and write one sentence that makes absolutely no sense, and the clear communication is not there. Picking up the phone and having those tough calls, even though, oh well, I'm going to get a coffee, or I just don't feel like it. And sometimes it's not about how you feel; it's about, hey, if I get this right the first time and have a clear, open communication, then I don't have to go back and forth 3 times to make sure that they understand what I'm saying. So picking up the phone and having that phone call and making sure that people understand exactly what's happening, at the end of the day, you're going to be better off on the other end, instead of going back and forth with 4 or 5 emails until finally somebody picks up the phone and says, okay, got it. All right. Well, guys, that's all the time I've got for the day. I hope that this has been useful information. And if not, hey, give me a topic you want me to talk about, and I'll be more than happy to cover it. Call me, as always, 903-806-4400, or text me at 832-871-4116. I'm always here to answer your hard money questions, and I'm also here to close all your hard money investment loans. That's it for this week from Rob at Jet Lending. We'll talk to you soon. Out here.